Let's take a look at how the market reacted to all of today's trade headlines. Stocks surging at the open after the president tweeted we're close to a big deal with China. Then we got a little complacent or maybe skeptical. The markets faded some midday. Then the news broke that Kayla just told you about. And boom, new highs. So, Mike Wilson, by the way, welcome. Does today's trade news change your outlook at all heading into the new year?
No, I mean, this is part of our outlook for 2020 is that we need this actually for the global economy to bottom in the first quarter, which is our call from our economists. I think what this really does is it adds fuel to the fire of the rotation we've been seeing. And we saw it more of that today where the cyclicals are kind of outperforming the defenses. Obviously, yields are now trying to break out. I'm not sure yet we're at that stage yet. But here's the risk of the deal, right? Obviously, markets top on good news, they bottom on bad news. This has been going on for a while. We finally have good news, and that's good. I think that helps the recovery next year. The question is how much has been priced. And I think the other
apparently all of it.
Well, I don't know. I mean, we'll see. I think in some insecurities it clearly has. I mean, obviously you'd have to live under a rock not to know this deal was coming. Okay, so it's here, and it's good that we got it done. Now, the risk on the other side is, was there pull forward demand in front of Sunday's threat of tariffs? And if there is, then we could have a little bit of an air pocket in the first quarter. I don't think it'll be material enough to derail the economy, but it could derail some of these, some of these more cyclical stocks that have had a big move. We're hedged. We have financials, and we're also overweight staples, and we have our cyclical exposure actually outside the U.S. We've been overweight Japan and Europe because that's a cheaper way to get cyclical exposure to trade. And by the way, both of those economies are much more levered to trade anyways.
Does this material, by the way, label me the person that was living under a rock. And this was basically the same deal, I think, that they announced on October 11th, 200 or so S&P points again. And I've said this, and I'll say it again. President Trump has done a masterful job of speaking to the market through Twitter, through his words. Good for him. With that said, does this materially change the earnings forecast for 2020?
No, and that's the thing, and it doesn't change our economic forecast, and it doesn't change our earnings forecast materially for the S&P 500. It does change it potentially for some of the economies geared towards global trade, potentially, say Japan, maybe Germany, maybe South Korea, some of the areas that have been actually hurt by trade more materially, and maybe some of the more cyclical areas that we could see a pickup in demand. But once again, though, Guy, I do think there's been some pull forward in certain areas, semiconductors being probably the most obvious one, where there's been pull forward of demand because that's an area that was going to get tariffed on Sunday. If that's no longer going to happen, we may see a little bit of a pullback in some of those orders.
What if we get part of this deal where they roll back some of the existing tariffs?
Yeah.
Would that increase your S&P earnings estimate for next year?
It could, potentially, absolutely. That's not in our base case forecast. We don't know the answer to that yet. I think that's probably for phase two. And we don't know the timing of phase two yet. Our public policy strategist thinks that phase two could be something after the election. That may take a while longer to get those rollbacks. We'll see. This has been it's a fast-moving situation not in terms of getting it done. It's been taking a long time, but it's fast-moving in terms of it's flip-flopping back and forth. What is actually in the deal? What's going to get papered? What's going to be agreed to by handshake? There's a long road here, and I agree with you, Guy. The president's been masterful in using a phase one, talking to the market, seeing the reaction, and using it to his advantage.
Especially when this deal looks like it's mostly about ag and not about IP and IT, which are the reasons we are supposedly doing this deal. But you talked about, I thought one of the most extraordinary moves today was in rates. And the fact that you're also continuing to see this uplift in anything that's a reflation trade.
Yep.
So the rotation into resources, into commodities, is this something that continues? These are great looking charts.
Yeah, look, I mean, we're overweight value as well relative to growth. I mean, we think that's the real value-added idea, meaning the growth stocks have benefited tremendously from this sort of shallow recovery, fear about trade, et cetera, and they got overvalued, and lower rates is part of that. So lower rates moving up is damaging to those stocks. That money's got to move somewhere. I think financials is the first place,
banks outperform,
and then potentially energy and potentially materials. And we have started to see some of the commodity prices themselves have a bit of a move in the last week. So that's all related to the same thing.
Mike, when you look at the deep cyclicals, whether it's European autos, whether it's copper, whether it's Hong Kong, I mean, these have now been turning for 3 or 4 months.
That's right.
So wasn't it already in the charts that something here was going to have a positive outcome?
Absolutely. And it's a combination of a lot of things. Trade is part of it, but also was those stocks got priced for recession, right? That's what August was. August was the cyclicals being totally thrown out the door, pricing in a recession. So they've been recovering for a lot of reasons. Part of that is that we avoided a recession for now, right? And trade is another boost to that. I also think what's going on in the election in Great Britain is a big deal. right? So that has made progress as well. We don't know the results yet. They're coming out shortly, but that could be a real positive for potential fiscal stimulus, which is another catalyst for these cyclical areas.
Well, and by the way, Dan, I don't want you to get in here, but to that effect, we're going to get to more on the British vote. But when at the top of the show, when I was looking down, there were some headlines crossing that it looks like Boris Johnson may be able to keep that conservative majority. So we'll get more on that in a second. Sorry about that, Dan.
Yeah, no problem. So, interesting point about the reflation trade. And the last time we really thought about this was 2018. It came after that big the big tax cut in late 2017. We saw rates go back up, right? So what did we see this year? We saw rates go down in front of what was 3 consecutive rate cuts by the FOMC. So here's the thing. Is 2020 going to be a lot like 2018? The stock market was very volatile. We had rates going up because people felt better about global growth, that sort of thing. But it was a volatile year, and we had that big sell-off from the Jan highs to the February lows. It took, 7, 8, 9 months to get back to those prior highs. Does 2020 set up potentially like that if we pulled forward a lot of the market performance because of this anticipated news?
I think there's one big difference, Dan, which is that in 18, the U.S. was leading the economic expansion because we had the fiscal stimulus. Now it's the global economy that's actually bottoming, okay? And part of that is because they went into a slowdown first. They're more affected by the trade. Quite frankly, the U.S. economy is more closed. And I would argue that the U.S. economy is actually going to bottom later than the global economy, which may actually keep downward pressure on U.S. rates, okay?
How is that possible when we started reinflating before everybody else? Why is our life cycle going to be that much longer and stronger?
Because we pulled forward a lot of demand, Brian. We did a fiscal stimulus that was gargantuan in 2017 that fed through 18. And one of the things that's done is created cost pressures for companies. So our call this year, the part of our call that was really right was that we had an earnings recession and we didn't have any earnings growth this year as well. And the small mid caps are really suffering. The trade deal does not alleviate that pressure. That's unique to the United States, and it may keep downward pressure on Treasury rates. So we're actually long Treasuries because that's a hedge against our cyclical bet, right? We're not going all in on kind of a reflation trade yet.
Think about what the Fed, though, has done. And today, you could also make an argument. Fed announces $365 billion in term repos between now and into next year. That balance sheet dynamic may be more important than anything.
Yeah, I'm glad you mentioned that. I mean, we wrote about that a lot this week, and we think the single biggest factor in the reflation trade is that the Fed, first of all, they ended QT, okay? They ended QT, and they cut rates 3 times, and they're doing $60 billion a month plus overnight repo operations. If you look at the year-over-year rate of change on the Fed balance sheet, it bottomed in August, and it's literally gone vertical. So the way that transmits into the equity market is through vol. So S&P 500 30-day realized vol is at 6. Okay, that's
what does that mean?
That's unnatural.
That's a lot
unnatural.
Of words.
So 6 on a 100-year basis is in the 0.5 percentile. It's literally off. It's as low as you could see. Okay, and we wrote about this extensively last week because we think it's attracted a lot of CTA flows. Yep. And vol targeting flows to the tune of about $175 billion in global equities just over the last 2 months. So that's look. I mean, I think that is a conversation that people talk about this, the Fed balance sheet, but they haven't quantified it. We tried to quantify it, and look, it's going to persist. It's going to persist through year end for sure, and probably into the first quarter.
Mike, I'm sorry, Chris. Go ahead.
I think what you're describing is an environment that's still driven by liquidity here, and I think we need to remember 10-year yields are 150 basis points where they low 12 months ago, right? So that is still very stimulative. Money growth's running 10% annualized. So when you think about that, is that more bullish for rest of world in 2020 than it is domestically?
We think it is. That's how we're positioned. We think, look, if you're pro-cyclical, you think growth is going to get better, play the higher beta areas, right? The S&P 500 has been outperformed because people have been nervous. It's the defensive equity market. Doesn't mean it goes down, just underperforms.
We're going to get to Willem Marks in just a second in the UK, but I think, Guy, you've been talking about this repo thing. How can we not have this $300 billion plus repo thing in 2 days, the day before and the day after New Year's, and it not be a major dent in the equity market?
I don't know I wish I knew the answer. Nobody, there are a few people paying attention, you being one of them. I think all of us on this desk have tried to talk about it. I think the Fed clearly sees some problem child out there that they're trying to deal with through this overnight repo rate that started on September 17th, I think, or thereabouts, when the rate spiked to 10%. What's going on? Is that the sort of the boogeyman out there, that there's some distressed bank that they're trying to carry through for as long as they possibly can? Or am I just sort of reaching here?
Well, look, the consensus view, and we would share this view, is that we had a drain on reserves. The Treasury had to raise a bunch of money to pay for the fiscal deficit. That was about $300 billion of fundraising. And the Fed underestimated how much excess reserves they needed in their overnight in the banking system. At 1.2 trillion, actually, they thought it would be 800 billion. So they missed that mark by $400 billion. And obviously the markets reacted to that. There was also corporate tax payments that had to be made in the third quarter. That's the common belief. Okay. Now they've been plugging this hole for a while, and it hasn't been resolved yet. We think seasonally this is the time of year when banks need more liquidity. So I think it's okay that this is persisting through year end. If we see this persist after year end, then I think we got a bigger problem.